This is video 4 of IAS 20. In this video, we will start to look at the types of grants. We've already looked at the background, scope, definitions, as well as recognition of grants. And now we will be focusing on the presentation of government grants. As we've said, there are two types of grants. You get asset-based grants and income-based grants. Each one of these has a different definition, and you use this definition in order to distinguish between asset or income-based grants. So in a scenario, you will need to identify whether it's an asset or an income-based grant. In this video, we're going to focus on asset-based monetary grants. So in a case study, you must identify whether it's an asset or an income-based grant based on the definitions. If it is an asset-based grant, you need to decide whether it's a monetary or a non-monetary grant. Monetary grants are something like money, and a non-monetary grant is an asset you receive. So here's our definition of an asset-based grant. It's where the primary condition is to purchase, construct, or otherwise acquire a long-term asset. There can be subsidiary conditions like the type or location of the assets or the periods during which they are to be acquired or held. Then, as we see, this is a long-term asset. Okay, so this means it also links with our paragraph 12, which says that our systematic basis we're going to use is the same as the depreciation charge. Okay, so this definition you use to distinguish between what type of government grant it is. Then just on another note, we're going to look at what is the effect on the statement of cash flows. The only thing you guys need to note here is that you have two cash flow items. You have one where you acquire the asset and the other one where you receive the grant. For example, if you acquire an asset for 10 million rand, that's one event, and where you receive the grant of 2 million, that's another event. It's two separate economic events which you show separately, and you show it separately irrespective of the accounting treatment that you use. If you have identified in a case study that it is an asset-based monetary grant, there are two ways to present this grant. The first option is you offset it against the cost of the asset, or you create a deferred income. Okay, in a scenario, we will tell you which one was used, or you must be able to discuss both options. So option 1, offset against the cost of the asset. So what happened? You received a grant, so you debit your bank, and now you need to credit something. And here you credit the cost of the asset. Okay, and we still need to meet the requirements of paragraph 12, the systematic basis. But here, if you think about it now, you have a smaller depreciation, and therefore you still meet the requirements of paragraph 12. Okay, whereas with option 2, here you still receive the money, debit bank, but now you're crediting a deferred income in your SFP. So you're creating a liability in your SFP. But then you have to amortize this deferred income to profit and loss. So what do? You decrease the liability, you debit your deferred income, and you credit the government grant amortized in profit and loss. Okay, so you still amortize it over the same useful life as the asset, but now you have a separate income in profit and loss. So you need to know both of these methods. Then just remember, monetary grants means money. For example, it can be cash that you receive, or it can be a reduction in a loan. Okay, and you receive this money to buy an asset. So let us look at an example. Superman Limited acquires a manufacturing plant for 8 million on 1 March 2010 and thereby qualifies for a cash subsidy of 2 million from the government. So what was the reason for this subsidy? It was for the manufacturing plant, which is an asset. So it tells you that this is an asset-based grant. Then we received cash. This cash subsidy means that it's a monetary grant. So we know we have an asset-based monetary grant. The plant was immediately available for use as management intended, and it is written off over a straight line basis over an estimated useful life of 4 years. The residual value is insignificant. So here we know we're using this for our depreciation as well as our paragraph 12 systematic basis. The 2 million subsidy was received from the government on 1 March 2010. Superman Limited has a 28 February reporting date. So now we know we have an asset-based monetary grant, and we know we have two options of presentation from which we can choose. Okay. We are looking at the first option, which is to credit the asset. So the company buys the manufacturing plant, which is the journal we all know. Then when we receive this grant, we debit our bank, and then we credit our manufacturing plant, which is the cost of this asset. Okay, very important. Then when we write off depreciation at the end of the year, remember now we have a different cost. We have the 8 million subtract the 2 million subsidy because that's the presentation method we chose, and we divide it by the 4 years. Remember, we are still meeting the requirements of paragraph 12 because now we just have a reduced depreciation amount going to profit and loss. So let's look at what is the impact on the statement of financial position and what is our impact on our statement of profit and loss and other comprehensive income. Very important, like we've said. We now have a 6 million cost of this asset instead of the 8. Then we have our accumulated depreciation over the year, and the carrying amount is what you would disclose on your SFP. Then in our statement of profit and loss, we only have one depreciation and only one amount that was affected in profit and loss. And just note, in this option, there's no liability. If we chose option 2, which is to create a deferred income, the first journal would remain the same because we acquired this manufacturing plant. Then here, with our second journal, we still receive the money, debit bank, but now we are crediting our deferred income, which is a liability, in the SFP. Very important. Now, at the end of the year, when we write off our depreciation, we use the 8 million and not the 6 million as in option 1. Very important. Then, to meet the requirements of paragraph 12, we know we have to amortize the deferred income to profit and loss. So we take our 2 million, but then we use the same depreciation as with the assets, which is the same useful life, and we amortize the 500,000 to profit and loss. Basically what you're doing is you're decreasing your liability and increasing your profit and loss. So let's go and look at what's the effect on the statement of financial position and our effect on the statement of profit and loss and other comprehensive income. The first thing that I want you guys to see is that here in this option we have a liability as well as we have an income, which we did not have in the previous option. So in this option, in our assets, we have an 8 million cost versus the 6 million of the previous option. Then you just have your depreciation. Then lastly, under the liabilities, what was the amount of the deferred income left? We had the 2 million and we amortized 500,000. So we have 1.5 million left. But remember, IAS 1 requires us to distinguish between current and non-current liabilities. So we know that every year we are going to amortize 500,000. How? Because we know we're writing it off as the same as our asset. So we know we're going to amortize 500,000 every year. So next year 500,000 will be amortized, so that is current, and that means that the 1 million is non-current. Then here in our statement of profit and loss, we have a depreciation which is 2 million, and then we have our deferred income amortized 500,000. Now what you guys can go and do is compare the two options and go and look at the effect in profit and loss. But the effect in profit and loss is the same. Why? Option 1 had a negative 1.5 million. Option 2 has a negative 2 million but a positive 500,000, which in effect is negative 1.5.